During 2024, we had many big winners. We started the year strong with the buyouts of Tricon Residential and Apartment Income REITs, both of which resulted in large gains over a short time period. Then more recently, we also sold IRSA, which is a leading Argentinian REIT, also Simon Property Group and Regency Centers, each more than doubling our money. We also had some smaller wins in Stag Industrial, Global Medical REIT, Avalon Bay Communities, Outrun Media, and Essential Properties Realty Trust. Therefore, I had significant realized gains for 2024, and this pushed me to sell some of my biggest losers of all time in order to reduce my tax liability. Hey everyone, this is Yusuf. I run a small investment firm that specializes in REIT investing, and in today's video I'm going to discuss those two big losers of 2024 that almost resulted in a complete loss if you ignore the dividend. But before I get into it, I want to remind you that we're still offering a 2-week free trial for our REIT newsletter, High Yield Landlord. So if you want to access all our top picks going into 2025, now is a great time to join us for the free trial. While it's still active, it will be the first link in the description of this video. So before I go into the first company, I want to note here that we've been running High Yield Landlord, which is my REIT newsletter, for 6+ years now, and so we've picked up a few investments over the years that have resulted in significant capital losses. I've put off selling them for a long time, hoping that we'll get some good news down the line, but ultimately these positions have become a distraction. They've become too small in size to justify our time and effort, which is today better spent on other investments, and so ultimately they're not worth the potential reward. We take risks to earn returns, and sometimes risk factors play out, and in this specific case we think that both of these companies fell victim mostly to the black swan of the pandemic and then the following surge in interest rates, which was just too much for their balance sheets. So the first company that I'm going to discuss here is called Invesque. Its ticker symbol is IVK.U. This is a Canadian REIT-like entity that specializes in senior housing. The thesis here is that we're getting a steep discount for senior housing relative to other REITs in the US like Ventas or Welltower, in exchange of accepting the higher risk of its weaker balance sheet. The expectation for us, and this was mostly our thesis, was that as the company then deleverages its balance sheet, the market would revalue the company to a higher multiple as more investors become comfortable owning a position in the company. But then came the pandemic, and its high leverage wasn't manageable anymore. It suddenly forced Invest to start selling properties to pay off debt and renegotiate its debt terms and covenants in order to stave off a potential bankruptcy. In the process, they also returned a lot of capital to shareholders, reducing our investment in the company. But today there just isn't much left of the company for shareholders, resulting in a near complete loss. They are trading as a penny stock. I think the share price is something like 10 cents, and the market is quite confident that the company is not gonna make it. They are flirting with bankruptcy, and so the size of our investment had become so small that even if the company earned a 5x or 10x, this really wouldn't have a material impact on our overall portfolio performance. However, taking the tax loss would at least allow me to reduce my tax liability, and so this really moves the needle for me, and ultimately this is why I decided to part ways with Invesque. The second company that was a near complete loss for us in 2024 was a company called Core Energy Infrastructure Trust. Its ticker symbol is CORR. We knew that this was a riskier company, again because of its higher leverage and also the concentration of its assets, but we thought that we'll be better protected by investing in the preferred equity of the company. At the time, it enjoyed significant asset level coverage, and its preferred dividend was just a tiny fraction of its cash flow. But what we failed to recognize back then is that in the event of a bankruptcy, the preferred shareholders would have little representation in a court, and what belongs to them on paper probably wouldn't matter in practice. They got cheated and didn't get more than a token interest in the common equity of the new company. Our position size is so small again that it doesn't really justify our time and effort or the research cost in following this company. So here again we had two options. We could buy more shares of the company or simply part ways with it. Ultimately we didn't feel comfortable buying more of it based on how the company is doing, its valuation, its future prospects. And so we decided to sell it to book the tax loss. This again is going to reduce my tax liability. So now comes the most important part of the video. What are the lessons in these big losses that I booked in 2024? Earlier this year, in a separate article at High Yield Landlord, I explained that in hindsight, it's evident that nearly all of our speculative investments have ended up losing us money. It's not just our picks, by the way, but highly speculative, riskier REITs in general have performed poorly over time. So I'm here referring to REITs like Global Net Lease or Industrial Logistics Properties Trust, both of which are often pitched on Seeking Alpha, Substack, YouTube, and elsewhere. These are REITs with conflicted management teams, high leverage, lower quality assets. These type of REITs as a whole have performed very poorly over time. Typically, if you take higher risk, you would also expect to earn higher returns to justify taking this risk. But in the case of REITs, this just hasn't been the case in the past. On the contrary, investors who invested in safer REITs like realty income have done far better over time than investors who favored riskier peers like global net lease. So one of the lessons here is simply that the REIT market is very inefficient, and so higher risk doesn't equate to higher returns over time. In many cases, it's the contrary. Another lesson is that if it sounds too good to be true, it probably is, and this applies really well to invest. We thought that we were getting a steep 50% plus discount, but ultimately we lost almost everything. So even a steep discount doesn't guarantee that you won't lose money, especially if the balance sheet is not ready to survive some major black swan like the pandemic or historic surge in interest rates. Another lesson here is that no matter how low the valuation gets, a conflicted management team can always ruin everything. And this was, I think, a lesson for Core Energy Infrastructure Trust. We didn't do enough work vetting the management team, and ultimately I think that they didn't do a particularly good job. The fourth lesson here is that the balance sheet of a REIT should be strong enough to survive a black swan, because yes, black swans are unexpected, surprising events, but they are going to happen. We've had black swans in every decade. We're going to keep having more of them. Over the past 5 years alone, we've had 2 with the pandemic, well, even 3, the Russia's invasion of Ukraine, the surge in interest rates. So black swans are going to occur, and we need to prepare for it. The balance sheet needs to be strong enough to survive one. If it's not, you're really just speculating and not investing. The fifth lesson is that the preferred equity really doesn't provide much additional protection relative to the common equity in case of a bankruptcy, and we had to learn this the hard way with Core Energy. We won't make the same mistake again in the future. And then the final and perhaps most important lesson for us, and I mean we've known this already for a while, but these investments reaffirm again this lesson, is that quality value is better than deep value. And what we mean by this is that quality value are high quality REITs, typically that are going through some type of temporary issue. So a good example here would be Rexford Industrial Trust. This is a high quality REIT with an amazing track record, Class A assets, fantastic management team, but they are temporarily suffering from oversupply today, and so it's discounted because of this. It's quality value, high quality, but good value because of this temporary issue. We think that as the oversupply gets absorbed over the coming years, the REIT eventually will recover and richly reward shareholders. Deep value, on the other hand, are lower quality REITs that suffer not just temporary issues, but more permanent structural issues like a conflicted management team, over leverage that they have difficulty bringing down. We think, and based on our experience, deep value really rarely rises up to the occasion. Often they are even cheaper REITs, but ultimately, if you don't have a catalyst to unlock this upside, this is going to become a value trap, and you're taking much higher risk in the case of deep value REITs, especially if some black swan events plays out, which could easily push their over-leveraged balance sheet into even more dangerous category and perhaps force them into bankruptcy. So for all these reasons, you can expect us to focus a lot more on higher quality REITs experiencing temporary issues in the future, and less on these highly speculative situations like we have sometime in the past, not just with these 2 companies, but with some other ones as well, like Unity Group, Clipper Realty as well. There are quite a few other speculative REITs, and again here I don't mean to say that all of these have been disappointing investments. Some of our most speculative REITs have earned us significant returns. NAREIT is a great example. We bought a lot of it during the pandemic at around $5 per share. It's over $20 today. So some of them have been successful, but on average, these speculative investments of ours have performed poorly over time. We've recognized this, and for this reason, we expect to focus a lot more on higher quality REITs like Rexford in the future. Thank you very much for listening till the end. If you think that this video was useful, please click the like button. That helps me a lot to keep on growing. Subscribe to the channel. We're planning quite a few REIT CEO interviews on this YouTube channel in 2025. And finally, once more, if you want to access my full portfolio going to the new year, you can join High Yield Landlord for a 2-week free trial. It will be the first link in the description of this video. Thank you very much, and see you at my next one. Bye-bye.